Agriculture Supply Chain Finance. Table of Content. Introduction. Chapter 1. Introduction to Agricultural Supply Chains. Chapter 2. Understanding Supply Chain Finance. Chapter 3. Agriculture's Unique Financial Challenges. Chapter 4. Working Capital and Credit in Agri-Chains. Chapter 5. Risk Management Instruments. Chapter 6. Digitalization and FinTech in Agri-Finance. Chapter 7. Role of Farmers and Farmer-Producer Organizations, FPOs. Chapter 8. Financial Institutions in Agri-SCF. Chapter 9. Government and Policy Frameworks. Chapter 10. Global Best Practices in Agri-SCF. Chapter 11. Sustainability and ESG Considerations in Agri-SCF. Chapter 12. Future Trends and Innovations in Agri-SCF. Chapter 13. Conclusion and Strategic Recommendations. Introduction. Agriculture remains the backbone of the global economy, feeding more than 8 billion people and employing nearly a quarter of the world's workforce. Yet for all its importance, agriculture continues to face a persistent challenge: access to timely, affordable finance. Farmers, especially smallholders, often operate on razor-thin margins, constrained by inadequate liquidity, volatile prices, climate shocks, and inefficient supply chains. The result is a cycle of underinvestment, low productivity, and vulnerability that affects not just rural communities, but the entire food system. Agricultural supply chain finance, Agri-SCF, has emerged as a powerful tool to address this financing gap. By leveraging relationships, data, and transactions across the agricultural value chain, Agri-SCF provides farmers, aggregators, processors, and traders with access to capital when and where they need it most. Unlike traditional farm credit, which often relies solely on collateral or credit history, Agri-SCF takes a more holistic view, financing based on future receivables, confirmed orders, and the strength of supply chain partnerships. This book is designed to be a comprehensive guide to Agri-SCF for practitioners, policymakers, researchers, and investors. Over the next 13 chapters, we explore the theory, practice, and future of agricultural supply chain finance, including foundations and models, how Agri-SCF works, from pre-harvest input finance to post-harvest warehouse receipt systems, risk management and policy, tools and frameworks to de-risk agriculture and build enabling environments, technology and digital transformation, the role of fintech, blockchain, IoT, and AI in making agri-finance faster, cheaper, and more inclusive, global best practices and case studies, lessons from countries and companies that have pioneered innovative models, sustainability and ESG, how Agri-SCF is driving climate-smart agriculture and social impact, future trends, what lies ahead for agri-finance, from tokenization to DeFi and carbon credit monetization. Our goal is to equip you with actionable insights, real-world examples, and strategic frameworks to transform agricultural finance in your context. Whether you are a banker designing a new product, a policymaker seeking to deepen rural credit access, an investor allocating capital to impact projects, or a farmer organization looking to scale operations, agriculture is at an inflection point. The next decade will determine whether we can feed a growing population sustainably, profitably, and equitably. Agri-SCF is not just about financing, it is about resilience, empowerment, and shared prosperity. This book invites you to be part of that transformation. Chapter 1. Introduction to Agricultural Supply Chains. 1.1. Importance of agriculture in the global economy. Agriculture remains the backbone of the global economy, employing over 27% of the world's workforce and feeding more than 8 billion people. The sector contributes significantly to GDP in developing nations and plays a vital role in food security, rural development, and poverty alleviation. Beyond food production, agriculture supports biofuel, textile, and pharmaceutical industries, making it a critical part of global trade. A well-functioning agricultural supply chain, ASC, ensures that food moves efficiently from farm to fork. It links farmers, input suppliers, aggregators, processors, logistics providers, wholesalers, and retailers into a network that delivers agricultural products to consumers. An efficient ASC lowers costs, reduces waste, and improves the livelihoods of all participants. 1.2 Structure of an agricultural supply chain. An agricultural supply chain typically consists of the following key stages. Input supply: seeds, fertilizers, pesticides, farm equipment, and technology. Production: crop cultivation or livestock raising on farms. Aggregation and storage: collection points, warehouses, and cold storage facilities. Processing: conversion of raw produce into consumable or intermediate products. Distribution and logistics: transportation to markets, wholesalers, or retailers. Retail and consumption: sale to consumers via supermarkets, wet markets, or direct-to-consumer channels. Each stage has distinct financial, logistical, and operational challenges. Understanding these challenges is the first step toward building financial solutions that meet the needs of farmers and businesses across the chain. 1.3 Key characteristics of agricultural supply chains. Agricultural supply chains differ from other supply chains in several ways. Seasonality: production cycles are tied to growing seasons, causing cash flow fluctuations. Perishability: many products are highly perishable, requiring timely processing and transport. Fragmentation: millions of smallholder farmers participate, each with limited bargaining power. Price volatility: prices fluctuate due to weather, global demand, and market shocks. High risk: production is vulnerable to pests, diseases, and climate variability. These characteristics create a need for specialized financing solutions that account for risk, liquidity needs, and timing of returns. 1.4 Challenges in agricultural supply chains. Some of the major challenges faced by agricultural supply chains include infrastructure gaps. Inadequate roads, storage, and processing facilities lead to high post-harvest losses, often 20 to 30% in developing economies. Limited access to finance. Farmers often lack collateral, credit history, and access to formal banking. Information asymmetry. Farmers may have limited access to price, weather, and demand data. Market access. Small farmers struggle to connect with high-value markets or institutional buyers. These bottlenecks result in inefficiencies that ultimately impact food prices, farmer incomes, and food security. 1.5 Case Studies. Case Study 1. Dairy Supply Chain in India, Amul Model. Amul, one of the largest dairy cooperatives in the world, offers an excellent example of an organized agricultural supply chain. Problem: Indian dairy farmers were scattered and exploited by middlemen, receiving low prices for milk. Solution: the cooperative model aggregated milk from millions of farmers, set up chilling plants and processing facilities, and guaranteed fair prices. Impact: farmers saw steady income growth, India became the largest milk producer globally, and consumers got access to affordable milk and dairy products. This case highlights how organizing supply chains can empower farmers and attract financing by reducing transaction risk. Case Study 2. Cocoa Supply Chain in Ghana. Ghana is the world's second largest cocoa producer, and its cocoa supply chain is relatively well organized. Problem: farmers faced income volatility and limited access to credit. Solution: the Ghana Cocoa Board (COCOBOD) implemented a centralized marketing and financing system, including forward sales and syndicated loans from international banks. Impact: farmers benefit from stable prices, government-backed financing, and access to inputs, resulting in consistent production levels and foreign exchange earnings for the country. This case shows how government intervention and structured finance can stabilize an entire sector. Case Study 3. Fresh Produce Supply Chain in Kenya. Kenya exports fresh vegetables and flowers to Europe under strict quality and traceability standards. Problem: meeting European food safety and traceability requirements was difficult for smallholder farmers. Solution: Exporters partnered with farmer groups, provided training, pre-financed inputs, and created digital traceability systems. Impact: farmers gained access to premium export markets, earning higher incomes and becoming bankable clients for financial institutions. This example demonstrates how supply chain finance can enable compliance and unlock market opportunities. 1.6 Takeaways. Agricultural supply chains are complex networks with unique risks and opportunities. Case studies from India, Ghana, and Kenya show that with the right organization, financing mechanisms, and partnerships, these supply chains can become powerful engines of rural development and economic growth. In the following chapters, we will explore the financial flows within these supply chains, identify key bottlenecks, and discuss innovative supply chain finance solutions that address liquidity constraints, manage risks, and improve efficiency for all participants. Chapter 2: Understanding Supply Chain Finance. 2.1 Introduction to Supply Chain Finance, SCF. Supply chain finance, SCF, refers to a set of financial solutions designed to optimize cash flow across the supply chain. Unlike traditional financing, which focuses on individual participants, e.g., a farmer's loan or a processor's working capital line, SCF looks at the entire network of buyers, suppliers, and intermediaries to provide collaborative financing that benefits all parties. At its core, SCF bridges the gap between the need for liquidity, suppliers, and the ability to pay buyers by leveraging technology, data, and trust relationships within the supply chain. 2.2 Principles of Supply Chain Finance. SCF operates on a few foundational principles. Collaboration. Financing is based on relationships between buyers and suppliers. Risk mitigation. Lenders assess the creditworthiness of anchor buyers, reducing reliance on small suppliers' collateral. Cash flow optimization. SCF solutions aim to accelerate supplier payments while allowing buyers to maintain or extend payment terms. Transparency. Enhanced visibility into orders, invoices, and payments builds trust and lowers financing costs. 2.3 Financial flows versus physical flows. An agricultural supply chain has two parallel flows. Physical flow, the movement of inputs and products, seeds to farms, crops to processors, goods to markets. Financial flow, the movement of money, pre-harvest input credit, payments to farmers, processor financing, distributor credit. SCF aligns these flows by ensuring that financing matches the timing of production cycles, so farmers and businesses do not face cash shortages at critical stages. 2.4 Traditional versus supply chain financing. Traditional financing often requires collateral, extensive paperwork, and long approval timelines, which excludes many smallholders. Supply chain financing uses the strength of the buyer-supplier relationship to extend credit, making it faster, cheaper, and more inclusive. 2.5 Common SCF instruments. 1. Pre-harvest finance. Provides farmers with working capital for seeds, fertilizers, pesticides, and labor before production begins. Mechanism. Advance credit extended directly or through input suppliers. Benefit. Ensures timely sowing and optimal use of inputs. 2. Post-harvest finance. Offered after harvest to help farmers or traders store, produce, and sell when prices are favorable. Mechanism. Warehouse receipt financing is common. Produce is stored as collateral. Benefit. Prevents distress sales at low prices. 3. Invoice discounting, receivables finance. Allows suppliers to receive early payment on approved invoices. Mechanism. Lender pays the supplier at a discount, collects from buyer on due date. Benefit. Improves supplier cash flow and reduces default risk. 4. Distributor, dealer finance. Provides credit to distributors and retailers to stock inventory. Mechanism. Anchor company partners with financiers to underwrite credit. Benefit. Ensures product availability and steady sales. 5. Input supplier credit. Input companies finance farmers' purchases and deduct repayments from crop proceeds. Mechanism. embedded finance integrated with sales contracts. Benefit: improves input sales and farmer productivity. 2.6 Role of technology in SCF. Modern SCF platforms use digital tools to increase speed, transparency, and risk assessment. E-invoicing, automated invoice generation and validation. Blockchain, secure tamper-proof transaction records. IoT and remote sensing, crop monitoring for credit risk assessment. AI and analytics, alternative credit scoring for farmers with no formal credit history. 2.7 Case studies. Case Study 1. NAFED's Warehouse Receipt Financing, India. The National Agricultural Cooperative Marketing Federation of India, NAFED, supports farmers by allowing them to store crops in accredited warehouses and obtain bank loans against warehouse receipts. Impact: farmers avoid distress sales, hold inventory for better prices, and repay loans after selling. Case Study 2. ABSA Bank's Agri-SCF program, South Africa. ABSA Bank developed a digital platform connecting agribusinesses, input suppliers, and farmers. Mechanism: farmers receive pre-approved input credit based on purchase orders from large buyers. Impact: improved input usage, higher yields, and better repayment rates. Case Study 3. Olam Supplier Finance Program Global. Olam International works with over 5 million farmers worldwide. Solution: Olam partners with local banks to offer input credit and uses digital traceability systems. Impact: strengthen farmer loyalty, improve product quality, and reduce procurement risk. 2.8 Key takeaways. Supply chain finance is more than a financial product. It is a system of collaboration that strengthens the entire agricultural ecosystem. By leveraging anchor buyers' creditworthiness and using technology, SCF enables faster, cheaper, and more inclusive financing. This improves farmer resilience, reduces supply chain disruptions, and increases food system efficiency. In the next chapter, we will explore the unique financial challenges agriculture faces, from climate risk to price volatility, and examine how SCF can be tailored to address them. Chapter 3. Agriculture's Unique Financial Challenges. 3.1 Introduction. Agriculture is unlike any other industry when it comes to financial needs and risks. While other sectors can often rely on steady production schedules and predictable demand, agriculture faces numerous uncertainties that complicate cash flow management and access to credit. Understanding these challenges is critical to designing effective supply chain finance (SCF) solutions. 3.2 Seasonality and cash flow cycles. Agricultural production follows natural cycles tied to planting and harvesting seasons. Farmers incur significant costs upfront: seeds, fertilizers, labor, irrigation, but only generate revenue months later when they sell their harvest. This mismatch creates periods of liquidity stress. Example: a rice farmer in Southeast Asia may spend 60 to 70% of annual expenses in the first 2 months of the season, but only receive payment 6 months later, leading to dependence on informal moneylenders. Impact on finance. Increased demand for short-term working capital. High borrowing during planting season can lead to debt traps if yields or prices disappoint. 3.3 Weather and climate risk. Agriculture is highly dependent on climate conditions. Droughts, floods, and unpredictable rainfall patterns can wipe out entire crops. Example: in 2022, prolonged drought in East Africa led to massive crop failures, leaving millions food insecure. Financial implications. Higher credit risk for lenders. Reduced willingness to provide pre-harvest finance without risk mitigation tools like crop insurance. 3.4 Price volatility. Agricultural commodity prices are affected by global markets, currency fluctuations, and demand shocks. Example: the 2020 COVID-19 pandemic caused milk prices to collapse in many regions, leaving dairy farmers with unsold inventory. Financial implications. Farmers are unable to forecast revenue accurately. Lenders face higher default rates due to revenue shortfalls. 3.5 Fragmentation of production. Globally, over 500 million smallholder farmers produce more than 1/3 of the world's food. Most operate on less than 2 hectares of land. Challenges: lack of economies of scale, limited bargaining power with buyers and input suppliers, difficulty in meeting quality and quantity requirements for large institutional buyers. Financial impact: small ticket sizes make financing expensive. High transaction costs for lenders to serve dispersed populations. 3.6 Post-harvest losses and infrastructure gaps. Post-harvest losses range from 15% to 30% in many developing countries due to poor storage, inadequate transport, and lack of cold chain facilities. Example: in India, an estimated $14 billion worth of food is wasted annually because of poor logistics. Financial impact: lower farmer incomes. Lenders reluctant to finance perishable produce without guaranteed offtake. 3.7 Limited access to formal finance. According to the World Bank, only about 10% of smallholder farmers in sub-Saharan Africa have access to formal credit. Causes: lack of collateral, poor credit history or no credit history, high cost of serving rural areas. Consequences: reliance on informal lenders charging exorbitant interest rates, inability to invest in productivity-enhancing technologies. 3.8 Risk of side selling. Even when farmers receive credit or input financing from a buyer, they may sell to another buyer offering a higher spot price, breaking contract agreements. Financial impact: increases default risk for financiers, reduces buyer willingness to invest in farmer development programs. 3.9 Case studies. Case study 1: Maize farmers in Zambia. Challenge: farmers depend on rain-fed agriculture and face price volatility at harvest. Solution: the Zambian Commodity Exchange introduced forward contracts and warehouse receipt systems. Outcome: farmers could store grain, access credit, and sell when prices improved, stabilizing income. Case study 2: Coffee farmers in Colombia. Challenge: coffee prices fluctuate globally, affecting farmer incomes. Solution: the Colombian Coffee Growers Federation offers price hedging instruments and access to low-interest credit. Outcome: farmers are protected from price shocks, leading to more consistent production. Case study 3: Smallholder financing in Kenya. Challenge: fragmentation and lack of collateral restricted farmers' access to credit. Solution: digital lending platforms like Twiga Foods and Apollo Agriculture use satellite imagery and mobile data for credit scoring. Outcome: thousands of farmers gained access to affordable loans, increasing productivity and repayment rates. 3.10 Key takeaways. Agriculture's unique financial challenges stem from its dependence on natural cycles, vulnerability to risk, and structural inefficiencies. These factors make conventional financing inadequate. Effective SCF solutions must synchronize financing with crop cycles, incorporate risk mitigation tools like crop insurance, use technology to reduce transaction costs and assess creditworthiness, create incentives that minimize side selling and strengthen buyer-supplier relationships. The next chapter will explore working capital and credit mechanisms specifically designed to address these challenges, providing a foundation for robust Agri-SCF solutions. Chapter 4: Working capital and credit in Agri-Chains. 4.1 Introduction. Working capital is the lifeblood of agricultural supply chains. Farmers, aggregators, processors, and distributors all require timely access to credit to finance production, procurement, processing, and distribution activities. A shortage of working capital at any stage can lead to bottlenecks, delayed deliveries, and reduced incomes across the chain. This chapter explores the different types of credit used in agriculture, financing mechanisms available, and innovative approaches that improve access to working capital. 4.2 Understanding working capital in agriculture. Working capital represents the liquidity needed to meet short-term obligations. In agriculture, this typically includes pre-harvest expenses, seeds, fertilizers, pesticides, irrigation, and labor costs. Post-harvest costs, storage, grading, processing, and packaging. Distribution costs, transportation, marketing, and wholesaler credit. The challenge is that revenues often come in lumps after harvest, creating a timing mismatch between expenses and income. 4.3 Sources of agricultural credit. 1. Formal financial institutions. Banks, rural credit cooperatives, and microfinance institutions, MFIs, offer loans to farmers and agribusinesses. Advantages: lower interest rates, structured repayment schedules. Challenges: high collateral requirements, lengthy approval processes. 2. Informal credit sources. Moneylenders, traders, and input dealers extend credit based on relationships. Advantages: quick dispersal, minimal paperwork. Challenges: high interest rates, sometimes exceeding 30 to 50% annually. 3. Supply chain financing. Buyers, processors, and aggregators extend credit as part of contract farming or input supply programs. Advantages: aligned with production cycles, repayment deducted from crop proceeds. Challenges: risk of side selling and dependency on a single buyer. 4.4 Financing mechanisms. 1. Input financing. Farmers receive seeds, fertilizers, and other inputs on credit, typically facilitated by input suppliers or anchor buyers. Example: contract farming arrangements where repayment is deducted at harvest. Benefit: ensures timely access to quality inputs, boosting productivity. 2. Purchase order financing. Lenders advance funds to suppliers against confirmed purchase orders from reputable buyers. Benefit: lowers risk for lenders by leveraging buyer creditworthiness. 3. Inventory and warehouse receipt financing. Produce stored in accredited warehouses is used as collateral for short-term loans. Benefit: allows farmers to delay sales until market prices improve. 4. Invoice discounting. Processors or suppliers sell their approved invoices to financiers at a discount, receiving immediate cash. Benefit: improves liquidity without increasing balance sheet debt. 5. Distributor, dealer credit. Distributors and retailers receive financing to stock products, ensuring market availability. Benefit: stabilizes supply chain flow and supports downstream sales. 4.5 Innovative credit models. Digital lending platforms. Fintech companies use alternative data, mobile money transactions, satellite imagery, weather data to assess creditworthiness. Example: Apollo Agriculture Kenya bundles input loans with agronomic advice delivered via mobile apps. Group lending and joint liability models. Farmer groups or cooperatives borrow collectively, reducing default risk. Example: Grameen-style joint liability groups have improved repayment rates by leveraging social pressure. Value chain finance, VCF. Credit is embedded in commercial transactions within the value chain. Example: coffee buyers providing pre-harvest advances to secure supply. 4.6 Case studies. Case study 1. Contract farming finance, PepsiCo, India. Challenge: small farmers lacked funds to buy quality seed potatoes. Solution: PepsiCo partnered with banks to provide input credit and guaranteed buyback. Outcome: farmers improved yields, repaid loans on time, and PepsiCo secured a consistent supply of raw materials. Case study 2. Warehouse receipt system, Ethiopia. Challenge: farmers were forced to sell grain immediately at low prices. Solution: Ethiopia Commodity Exchange, ECX, introduced certified warehouses and allowed farmers to use receipts as collateral. Outcome: farmers accessed post-harvest finance, sold later at better prices, and increased incomes. Case study 3. Digital credit, Mshwari, Kenya. Challenge: millions of small farmers were unbanked. Solution: Mshwari, a mobile banking service, offers instant microloans based on mobile money history. Outcome: enabled farmers to access small working capital loans for inputs and emergencies. 4.7 Key takeaways. Working capital and credit are central to agricultural supply chain efficiency. Innovative credit solutions must be aligned with crop cycles. Reduce collateral requirements. Leverage technology for credit scoring. Mitigate default risk through aggregation and buyer linkages. In the next chapter, we will explore risk management instruments that protect both farmers and financiers from production, price, and market risks. Chapter 5: Risk Management Instruments. 5.1 Introduction. Risk is an inherent part of agriculture, and managing it effectively is essential for a resilient and efficient supply chain. Risk management instruments protect farmers, buyers, and financiers from potential losses due to weather events, market volatility, logistics disruptions, and credit defaults. This chapter explores key instruments and models used globally to mitigate these risks. 5.2 Types of risks in agriculture. Production risk, caused by drought, floods, pests, and diseases that affect yield. Market risk. Fluctuations in prices and demand can erode farmer profitability. Financial risk. Arises from inability to repay loans or access credit. Operational risk. Includes supply chain disruptions, transport delays, or quality deterioration. Institutional risk. Changes in government policy, trade restrictions, or subsidy removal. 5.3 Risk mitigation tools. 1. Crop insurance. Crop insurance protects farmers from yield loss due to natural disasters. Types. Yield-based insurance compensates for lower than average yields. Weather index-based insurance pays out based on rainfall or temperature triggers. Example: India's Pradhan Mantri Fasal Bima Yojana (PMFBY) insures millions of farmers against crop failure. 2. Price risk management. Price volatility can be managed through futures, options, and forward contracts. Futures contracts, standardized agreements traded on commodity exchanges. Forward contracts, customized agreements between buyers and farmers. Options contracts provide the right but not the obligation to sell at a set price. Example: Chicago Board of Trade (CBOT) futures help grain producers hedge against price drops. 3. Warehouse receipt financing. Certified warehouses issue receipts that can be used as collateral for loans. Benefit: allows farmers to delay sales until prices rise while accessing liquidity. Risk mitigation. Warehouses ensure quality preservation and reduce storage losses. 4. Collateral management. Third-party agencies monitor inventory pledged as collateral, reducing lender risk. Application. Commonly used by banks financing commodity traders and processors. 5. Input and output price hedging. Input suppliers and buyers hedge against price fluctuations of fertilizers, fuel, and agricultural produce to protect margins. 6. Diversification and crop rotation. Encouraging farmers to diversify crops reduces dependency on a single source of income and mitigates risk from crop failure. 7. Credit risk mitigation. Credit guarantees. Governments or development agencies share lender risk. Anchor buyer guarantees. Buyers guarantee repayment on behalf of farmers. 5.4 Technology-enabled risk management. Remote sensing and satellite imagery detect crop stress and predict yield losses early. Blockchain enhances traceability, preventing fraud in warehouse receipt financing. AI and predictive analytics forecast weather, disease outbreaks, and price trends. 5.5 Case studies. Case Study 1. Weather Index Insurance, Kenya. Challenge. Farmers face frequent droughts but found traditional insurance too expensive. Solution. Kilimo Salama developed weather index-based insurance triggered by satellite rainfall data. Outcome. Lower premiums, faster payouts, and improved farmer adoption of improved seeds and fertilizers. Case Study 2. Warehouse Receipt System Tanzania. Challenge: high post-harvest losses and distress sales. Solution: Tanzania introduced regulated warehouses, enabling farmers to obtain loans from banks against stored crops. Outcome: reduce losses, improve price realization, and increase credit flow to the sector. Case Study 3. Futures Market Participation, United States. Challenge: farmers were exposed to volatile corn and soybean prices. Solution: cooperatives train farmers to use futures contracts on CBOT. Outcome: farmers locked in profitable prices, reducing income volatility. Case Study 4. Credit Guarantee Scheme, Nigeria. Challenge: banks were reluctant to lend to agriculture due to high default risk. Solution: the Nigerian incentive-based risk-sharing system for agricultural lending, NIRSAL, provided risk guarantees. Outcome: increased agricultural lending, lower interest rates, and better farmer access to finance. 5.6 Key Takeaways. Risk management is the foundation of agricultural supply chain finance. Without risk mitigation tools, lenders and buyers remain cautious, limiting financial inclusion and investment. An effective risk management strategy should combine insurance products to protect against production shocks, price hedging mechanisms to reduce income volatility, technology-enabled monitoring for early risk detection, institutional frameworks that share risk among stakeholders. In the next chapter, we will examine digitalization and fintech innovations, which are transforming agricultural finance and enabling scalable, cost-effective solutions for risk management and credit access. Chapter 6: Digitalization and Fintech in Agri-Finance. 6.1 Introduction. Digitalization is revolutionizing agricultural finance by lowering transaction costs, increasing transparency, and enabling data-driven credit decisions. Fintech innovations are creating new ways to extend credit, collect repayments, and manage risk for millions of smallholder farmers and agribusinesses worldwide. 6.2 Drivers of Digital Transformation in Agriculture. Mobile penetration. Widespread use of smartphones and mobile money platforms in rural areas. Affordable internet. Expansion of 3G, 4G networks and satellite connectivity. Data availability. Increased use of remote sensing, farm management apps, and IoT devices. Demand for traceability. Consumers and regulators require visibility into sourcing practices. 6.3 Key digital tools in agri-finance. 1. Mobile money and digital payments. Mobile money platforms like M-Pesa Kenya allow farmers to receive payments and repay loans digitally, reducing the need for cash handling. Benefit: improves transparency, reduces leakages, and creates digital transaction histories useful for credit scoring. 2. Blockchain technology. Blockchain creates tamper-proof records of transactions, contracts, and supply chain events. Applications: digital warehouse receipts, smart contracts for automatic payment triggers, traceability of produce from farm to fork. 3. IoT and remote sensing. Sensors and drones monitor soil moisture, weather conditions, and crop health. Benefit: enables predictive analytics for yield forecasts and credit risk assessment. 4. Alternative credit scoring. Fintechs analyze non-traditional data sources such as mobile phone usage patterns, social media activity, satellite imagery of farmland. This helps include farmers with no formal credit history in the financial system. 5. Digital marketplaces and e-commerce platforms. Platforms connect farmers directly to buyers, reducing middlemen and improving price discovery. Example: Twiga Foods Kenya connects farmers with urban retailers, facilitating both market access and embedded finance. 6.4 Embedded finance in agri-supply chains. Embedded finance integrates credit and insurance into agri-commerce transactions. Input credit. Farmers receive seeds and fertilizers on credit through e-commerce platforms. Pay-as-you-harvest models. Loan repayments are linked to harvest cycles. Usage-based insurance. Micro-insurance premiums deducted digitally based on production data. 6.5 Benefits of digital agri-finance. Speed, instant credit disbursement and automated repayments. Cost efficiency, reduced administrative overhead for lenders. Scalability, ability to reach millions of farmers simultaneously. Risk reduction, real-time data improves monitoring and reduces defaults. 6.6 Challenges and considerations. Digital divide, not all farmers have smartphones or reliable internet. Data privacy, need for secure handling of farmer data. Financial literacy, farmers must understand digital tools to use them effectively. Cybersecurity risks, protection from fraud and hacking is critical. 6.7 Case studies. Case study 1, DigiFarm, Safaricom, Kenya. Solution: DigiFarm is a mobile platform offering farmers access to input loans, market information, and crop advice. Impact: over 1 million farmers enrolled, increased yields by 30% and improved loan repayment rates. Case study 2, FarmDrive, Kenya. Solution: FarmDrive uses alternative data, SMS surveys, satellite data, to build credit profiles for farmers. Impact: unbanked farmers gained access to affordable loans, with repayment rates exceeding 90%. Case study 3, Agri-Digital, Australia. Solution: blockchain platform providing real-time settlement of grain transactions. Impact: increased trust and efficiency in grain trade, reduced payment delays for farmers. Case study 4, Dahat, India. Solution: an integrated platform offering input delivery, advisory services, and market linkages. Impact: over 2 million farmers served, improved access to finance, and 20 to 25% higher price realization. 6.8 Key takeaways. Digitalization and fintech are unlocking new opportunities for inclusive agricultural finance. By leveraging mobile technology, blockchain, IoT, and alternative credit scoring, the industry can reduce costs and increase reach, provide timely and customized credit products, enhance supply chain transparency and traceability, build financial identities for smallholders, making them bankable. In the next chapter, we will discuss the role of farmers and farmer-producer organizations, FPOs, in strengthening supply chains and making them more attractive for financing solutions. Chapter 7, Role of Farmers and Farmer-Producer Organizations, FPOs. 7.1 Introduction. Farmers are the backbone of agricultural supply chains, yet most are smallholders operating on less than 2 hectares of land. Individually, they have limited bargaining power, low access to markets, and face challenges in obtaining affordable credit. Farmer-producer organizations, FPOs, and cooperatives have emerged as crucial vehicles for aggregation, collective bargaining, and improving financial access. 7.2 The need for farmer aggregation. Market access. Smallholders often cannot meet the quantity and quality requirements of institutional buyers. Economies of scale. Bulk purchase of inputs reduces costs, bulk selling improves price realization. Access to finance. Financial institutions prefer lending to organized groups rather than individuals. 7.3 What are FPOs? Farmer-producer organizations, FPOs, are legal entities formed by a group of farmers to collectively engage in production, procurement, processing, and marketing activities. Structure: typically registered as producer companies, cooperatives, or societies. Membership: voluntary, ranging from a few dozen to several thousand farmers. Governance: democratically managed, with profits distributed among members. 7.4 Functions of FPOs. Input procurement: aggregating demand to purchase seeds, fertilizers, and machinery at wholesale prices. Market linkages: negotiating contracts with buyers and processors for better prices. Financial services: acting as a conduit for credit, insurance, and subsidy programs. Capacity building: training farmers on good agricultural practices, GAP, and quality standards. Post-harvest management, setting up warehouses, grading centers, and cold storage facilities. 7.5 Benefits of FPOs in supply chain finance. Creditworthiness. FPOs provide group guarantees, reducing lender risk. Lower transaction costs. Banks can lend to one entity instead of multiple individuals. Reduce side selling. Collective marketing agreements encourage compliance. Improve traceability. Buyers gain visibility into sourcing and quality control. 7.6 Challenges faced by FPOs. Capacity constraints. Lack of managerial and financial expertise. Capitalization issues. Limited working capital for procurement and operations. Regulatory compliance. Navigating legal and reporting requirements. Member participation. Maintaining trust and active participation among members. 7.7 Enabling environment for FPO success. Government support. Grants, equity funding, and credit guarantees for FPOs. Capacity building. Training in governance, finance, and marketing. Digital platforms. Tools for record-keeping, procurement, and member communication. Partnerships. Collaboration with NGOs, corporates, and financial institutions. 7.8 Case studies. Case study 1. Amul Dairy Cooperative, India. Challenge. Fragmented dairy farmers exploited by middlemen. Solution. Farmers formed cooperatives under the Gujarat Cooperative Milk Marketing Federation, GCMMF. Outcome. Today, Amul is one of the world's largest dairy brands, with millions of farmer members earning steady incomes. Case study 2. Mahindra Samriddhi Initiative, India. Solution. Mahindra partnered with FPOs to deliver agronomy advice, soil testing, and link farmers to markets. Outcome. Increased farmer productivity by 8 to 10% and improved price realization. Case study 3. Producer organizations in Kenya. Challenge. Smallholders lack market access and credit. Solution. NGOs facilitated the creation of producer groups, enabling bulk marketing and access to microfinance. Outcome. Farmers secured better prices and increased adoption of improved inputs. Case study 4. Cocoa cooperatives in Côte d'Ivoire. Solution. Cooperatives partnered with global buyers like Nestlé and Barry Callebaut. Outcome. Farmers received training, access to finance, and premium payments for certified sustainable cocoa. 7.9 Key takeaways. FPOs play a transformative role in making smallholder agriculture more profitable and financeable. They aggregate supply, reduce transaction costs, and improve bargaining power, making them an essential partner in agri-supply chain finance. To unlock their full potential, stakeholders must invest in capacity building, digital enablement, and innovative financing models tailored to FPO needs. In the next chapter, we will explore the role of financial institutions in Agri-SCF, examining how banks, NBFCs, and fintech players are designing tailored products for the agricultural sector. Chapter 8. Financial Institutions in Agri-SCF. 8.1 Introduction. Financial institutions are critical enablers of agricultural supply chain finance, Agri-SCF. By providing working capital, risk management solutions, and payment infrastructure, they ensure smooth financial flows across the value chain. Their participation not only reduces liquidity constraints, but also brings credibility and stability to supply chains. 8.2 Types of financial institutions in Agri-SCF. 1. Commercial banks. Commercial banks provide the largest share of agricultural credit, especially for medium and large agribusinesses. Products offered: working capital loans, term loans for equipment, invoice discounting, trade finance. Role in SCF: act as anchor financiers, leveraging buyer creditworthiness to extend credit to suppliers. 2. Non-banking financial companies, NBFCs. NBFCs are agile players offering niche lending solutions to agri-ecosystem participants. Specialization: focus on underserved rural markets, often more flexible than banks. Examples: tractor financing, microloans to input retailers, post-harvest loans. 3. Microfinance institutions, MFIs. MFIs play a key role in reaching smallholder farmers who lack collateral and formal credit history. Loan size: typically small ticket loans with short repayment cycles. Group lending, joint liability group models reduce default risk. 4. Cooperative banks and rural credit institutions. These institutions are deeply embedded in rural areas and cater to farmer collectives. Advantages: proximity to farmers, familiarity with local conditions. Limitations: limited capital base, risk of political interference. 5. Development finance institutions, DFIs. DFIs provide long-term capital, guarantees, and concessional finance to promote agri-sector growth. Examples: NABARD, India, African Development Bank, IFC. Role: catalyze private sector participation by sharing risk. 6. Fintech lenders. New age digital lenders leverage data and technology to offer quick, small-ticket loans. Innovations: alternative credit scoring, pay-as-you-harvest models, embedded finance. Impact: inclusion of previously unbanked farmers and traders. 8.3 Partnership models between institutions and supply chains. Anchor-led financing. Banks partner with large buyers or processors, anchors, to finance their suppliers. Benefit: relies on anchors' creditworthiness rather than suppliers' collateral. Tripartite agreements. Buyer, supplier, and financier enter into a three-way contract, ensuring repayment from proceeds of sale. Risk-sharing facilities. DFIs and governments offer partial credit guarantees to incentivize lending. Co-lending models. Banks and NBFCs co-lend to spread risk and increase reach. 8.4 Role in risk management. Credit appraisal, assessing buyer and supplier risk profiles. Collateral management, ensuring safe storage of pledged commodities. Insurance facilitation, bundling crop or asset insurance with loans. Hedging services, helping clients manage commodity price risk. 8.5 Case studies. Case study 1. NABARD's Producer Organization Development Fund, India. Objective: provide financial and capacity building support to farmer producer organizations, FPOs. Mechanism: NABARD extends grants and concessional loans to FPOs for infrastructure creation. Outcome: thousands of FPOs gained access to working capital, increasing farmer incomes. Case study 2. Rabobank's agri-finance expertise, Netherlands and global. Solution: Rabobank, a global agri-specialist bank, provides supply chain finance solutions for agribusiness clients. Impact: improved liquidity for suppliers, reduced procurement risk for buyers, and enhanced traceability. Case study 3. MFIs empowering farmers in Bangladesh. Solution: BRAC offers microloans and agricultural training to smallholders. Impact: increased productivity, improved repayment rates, and financial inclusion for millions of farmers. Case study 4. Fintech Bank Partnership in India. Solution: ACC Bank partners with fintechs like Sumunati to offer digital invoice discounting to FPOs. Impact: faster credit dispersal, reduced paperwork, and lower interest rates for smallholders. 8.6 Challenges faced by financial institutions. High perceived risk, production and price volatility deter lending. Lack of reliable data. Credit assessment is difficult without verifiable farmer records. High transaction costs. Servicing dispersed rural clients increases cost to serve. Regulatory hurdles. Compliance requirements can slow credit delivery. 8.7 Key takeaways. Financial institutions are indispensable partners in Agri-SCF. Their ability to mobilize capital, manage risk, and innovate lending products determines how efficiently money flows across the supply chain. To deepen their impact, institutions must use digital tools to lower transaction costs, collaborate with FPOs and anchors to reduce credit risk, Bundle finance with insurance and advisory services. Leverage risk-sharing facilities to expand lending to underserved segments. In the next chapter, we will explore government and policy frameworks that support agricultural supply chain finance and create an enabling environment for private sector participation. Chapter 9. Government and Policy Frameworks. 9.1 Introduction. Government policies play a pivotal role in shaping agricultural supply chain finance, Agri-SCF. Well-designed frameworks can de-risk lending, incentivize private sector participation, and promote financial inclusion for farmers. Conversely, poorly structured interventions can distort markets or crowd out private finance. 9.2 Key Policy Objectives. Financial inclusion. Ensure access to affordable credit for smallholders. Price stability. Prevent distress sales and protect farmers from price crashes. Food security. Ensure consistent production and supply of staple crops. Risk mitigation. Provide safety nets against natural disasters and market shocks. Private sector participation. Encourage banks, NBFCs, and fintechs to innovate and invest. 9.3 Government Support Mechanisms. 1. Interest subvention schemes. Governments subsidize interest rates on agricultural loans to make credit affordable. Example: India's interest subvention scheme reduces the effective interest rate for short-term crop loans. 2. Credit guarantee schemes. Credit risk is shared between the government and financial institutions. Example: Credit Guarantee Fund for FPOs in India encourages lending without collateral. 3. Price support and procurement programs. Governments purchase crops at minimum support price, MSP, to stabilize farmer incomes. Impact: reduces risk of price volatility, enabling banks to lend with confidence. 4. Warehouse Receipt Systems, WRS regulation. Legal recognition of warehouse receipts as collateral enables post-harvest finance. Example: Negotiable Warehouse Receipt System, NWRS, in India regulated by WDRA. 5. Subsidies for insurance and input credit. Premium subsidies for crop insurance make risk cover affordable, encouraging farmers to borrow and invest. 6. Digital public infrastructure. Governments are increasingly building digital platforms to support agri-finance. Examples: ENAM, India, electronic marketplace for transparent price discovery. Agri-Stack initiatives, creating farmer databases to enable targeted credit and subsidies. 9.4 Regulatory frameworks. Priority sector lending, PSL, mandates banks to allocate a percentage of credit to agriculture. KYC AML norms streamline processes for small-ticket loans via simplified KYC. Commodity futures regulation encourages price hedging while protecting farmer interests. Data privacy laws ensure farmer data is used responsibly by lenders and platforms. 9.5 Public-private partnership, PPP models. Governments often collaborate with private sector players to implement large-scale programs. Input distribution. Private companies supply seeds and fertilizers under government schemes. Infrastructure development. PPPs for building warehouses, cold chains, and rural logistics. Blended finance. Combining concessional government funds with commercial capital to de-risk projects. 9.6 Global examples of policy success. Case Study 1. India's ENAM platform. Solution: created a unified national market for agricultural commodities. Impact: reduced price dispersion across states, improved farmer bargaining power, and enabled digital payment-based financing. Case Study 2. Ghana's fertilizer subsidy program. Solution: government partnered with private suppliers to deliver subsidized fertilizers. Impact: increased fertilizer adoption, improved yields, and attracted private agri-input investment. Case Study 3. Brazil's PRONAF program. Solution: national program for strengthening family agriculture provides subsidized credit. Impact: supported smallholder modernization, enhanced food security, and increased rural incomes. Case Study 4: USA's Farm Bill Programs. Solution: multi-year farm policy including crop insurance subsidies, direct payments, and rural development funds. Impact: stabilized farm incomes, encouraged investment, and maintained national food reserves. 9.7 Challenges and gaps. Targeting efficiency, risk of leakages and benefits not reaching the intended farmers. Fiscal burden: high subsidies can strain government budgets. Policy uncertainty: sudden changes in MSP or export bans can disrupt markets. Crowding out: excessive government procurement can reduce private sector participation. 9.8 Recommendations for policymakers. Focus on enabling environment, strengthen infrastructure and legal frameworks rather than direct market intervention. Encourage digital integration, build interoperable platforms for credit, insurance, and subsidy delivery. Promote risk-sharing instruments, expand guarantee funds and index-based insurance. Support FPOs, provide equity and working capital support to make them creditworthy. 9.9 Key takeaways. Government and policy frameworks are foundational to the success of Agri-SCF. By providing guarantees, digital infrastructure, and stable regulatory environments, they unlock private capital and reduce risk for all value chain participants. In the next chapter, we will explore global best practices in Agri-SCF, benchmarking successful models from leading agricultural economies. Chapter 10: Global Best Practices in Agri-SCF. 10.1 Introduction. Agricultural Supply Chain Finance, Agri-SCF, has evolved differently across countries depending on the maturity of their agricultural sector, financial ecosystem, and policy support. By studying global best practices, stakeholders can replicate successful models, adapt innovative solutions, and build robust inclusive systems in their own regions. 10.2 Criteria for Best Practices. Financial inclusion, ability to reach smallholders and underserved actors. Risk management, effective mitigation of production, price, and credit risk. Technology adoption, use of digital tools for transparency and efficiency. Private sector participation, incentives for agribusinesses and financiers. Scalability, ability to serve large numbers of farmers sustainably. 10.3 Best Practice Models by Region. 1. North America. Model: contract farming with integrated finance. Example: U.S. grain producers using forward contracts and crop insurance under the USDA framework. Key strengths: well-developed futures markets, CBOT, for price risk management. Strong crop insurance programs reduce lender risk. Farm credit system provides low-cost financing. 2. Latin America. Model: warehouse receipt financing and agribusiness-led models. Example: Brazil's CPR, Cédula de Produto Rural system. Key strengths: legally enforceable warehouse receipts and forward contracts. Blended finance programs under PRONAF for smallholders. Strong agri-input and processing companies driving embedded finance. 3. Europe. Model: cooperative-based agri-finance. Example: Rabobank's cooperative banking model in the Netherlands. Key strengths: member-owned financial institutions reinvesting profits back into farmers. Sophisticated risk-sharing and hedging mechanisms. Strong focus on sustainability and traceability. 4. Africa. Model: mobile money and index insurance solutions. Examples: M-Pesa and DigiFarm, Kenya, for digital payments and credit. Kilimo Salama, for weather index insurance. Key strengths: reaching remote farmers through mobile platforms. Low-cost, scalable microfinance and insurance. 5. Asia. Model: government-supported supply chain finance. Examples: India's ENAM platform and FPO support programs. China's state-backed agricultural credit guarantee funds. Key strengths. Strong digital public infrastructure, Aadhaar UPI in India. Integration of subsidies, credit and insurance through government portals. 10.4 Innovative global practices. Blockchain for transparency, used in Australia, Agri-Digital, and Europe for grain trade settlement. AI-powered credit scoring. Fintechs in Kenya and India using satellite data and phone usage. Impact investing. Blended capital funds supporting climate-smart agriculture in Africa. Green bonds, issued by global banks to finance sustainable agriculture. 10.5 Lessons for emerging markets. Legal frameworks matter. Secure collateral systems, warehouse receipts, contract enforcement, unlock credit. Digital ecosystems are critical. Farmer registries, mobile wallets, and e-marketplaces reduce transaction costs. Risk sharing boosts lending. Credit guarantees and insurance programs attract private banks. Aggregation is key. FPOs and cooperatives enable scale and reduce lender risk. 10.6 Case studies. Case study 1. Brazil's CPR model. Mechanism. Farmers issue CPRs, forward delivery contracts, to access credit from banks or traders. Impact. Deeply liquid market, high farmer participation, and strong private sector involvement. Case study 2. Kenya's DigiFarm platform. Solution. End-to-end platform offering credit, advisory, and market access. Impact. Increased farmer productivity by 30%, strong repayment track record. Case study 3. European Cooperative Finance, Rabobank. Solution. Member-owned cooperative bank providing loans, risk management, and knowledge sharing. Impact. Stable, farmer-centric financing system with global replication potential. Case study 4. USA's Farm Credit System. Solution. Federally chartered network of cooperatives providing low-interest loans. Impact. Long-term stability for the farm sector and strong alignment with policy goals. 10.7 Key takeaways. Global best practices demonstrate that successful Agri-SCF systems are built on a combination of robust legal infrastructure, enforceable contracts, and collateral frameworks. Technology integration, digital tools to reduce friction and improve data-driven lending. Risk mitigation, crop insurance, futures markets, and credit guarantees. Collective action, farmer organizations and cooperatives to aggregate supply and demand. Public-private collaboration, joint efforts between governments, financiers, and agribusinesses. In the next chapter, we will focus on sustainability and ESG considerations in Agri-SCF, exploring how supply chain finance can support climate resilience, responsible sourcing, and inclusive growth. Chapter 11. Sustainability and ESG considerations in Agri-SCF. 11.1 Introduction. Sustainability has become a central theme in global agriculture. Investors, consumers, and regulators are increasingly demanding that agricultural supply chains adhere to environmental, social, and governance (ESG) standards. Agricultural supply chain finance, Agri-SCF, can play a transformative role in accelerating the adoption of sustainable practices by linking financing terms to ESG performance. 11.2 The ESG imperative in agriculture. Environmental. Agriculture accounts for a significant share of global greenhouse gas (GHG) emissions and water usage. Social. Smallholder livelihoods, gender inclusion, and fair labor practices are key priorities. Governance. Transparent and ethical sourcing is essential for global buyers. 11.3 ESG risks in agricultural supply chains. Climate risk, droughts, floods, and temperature shifts affecting yields. Deforestation, unsustainable expansion of farmland. Labor rights issues, child labor and poor working conditions in some supply chains. Traceability gaps, difficulty in monitoring compliance across fragmented supply chains. 11.4 Green and sustainable finance instruments. 1. Green loans. Banks offer loans with preferential terms for sustainable farming investments, such as drip irrigation or renewable energy installations. 2. Sustainability-linked loans, SLLs. Loan pricing is tied to ESG performance indicators such as reduction in chemical pesticide use, increase in certified organic production, adoption of regenerative agriculture practices. 3. Green bonds and climate finance. Agribusinesses and governments issue bonds to finance climate-smart infrastructure, solar-powered cold storage, water-efficient irrigation systems, carbon sequestration projects. 4. Blended finance for ESG projects. Development finance institutions, DFIs, co-invest with private capital to fund high-impact projects that would otherwise be deemed too risky. 11.5 ESG integration in Agri-SCF. Credit assessment, incorporating ESG scores into supplier evaluation. Traceability systems, blockchain-enabled tracking of produce from farm to shelf. Incentive structures, lower interest rates for suppliers meeting sustainability criteria. Capacity building, training farmers in sustainable practices and compliance. 11.6 Measuring ESG impact. Key performance indicators, KPIs, used in Agri-SCF include environmental, GHG reduction, water savings, biodiversity conservation. Social, number of women farmers financed, improved farmer incomes, fair labor certification. Governance, share of suppliers with traceable certified produce. 11.7 Case studies. Case Study 1. Nespresso AAA Sustainable Quality Program. Solution: provides technical assistance and premium payments to coffee farmers adopting sustainable practices. Impact: higher incomes, improved coffee quality, and reduced environmental footprint. Case Study 2. Olam's at Source Platform. Solution: digital platform measuring social and environmental impact across supply chains. Impact: enhanced transparency for buyers and investors, improve farmer engagement. Case Study 3. IFC's Green Bond Program. Solution: mobilizes capital for climate-smart agriculture projects. Impact: reduce GHG emissions and improve climate resilience of farming communities. Case Study 4. Unilever's Sustainable Sourcing Finance. Solution: offers preferential payment terms to suppliers meeting sustainability criteria. Impact: accelerated adoption of responsible sourcing standards across its supply base. 11.8 Challenges in ESG integration. Data availability. Measuring impact at the farm level can be resource-intensive. Cost burden. Smallholders may struggle to afford certification or sustainable inputs. Incentive alignment. Need to balance profitability with ESG goals. Standardization. Multiple ESG frameworks can confuse suppliers and financiers. 11.9 Key takeaways. Sustainability and ESG considerations are no longer optional. They are becoming a prerequisite for accessing global markets and finance. Agri-SCF can drive systemic change by incentivizing sustainable practices through preferential financing, supporting traceability and certification using digital tools, mobilizing capital for climate-smart infrastructure, ensuring inclusive growth by empowering women, youth, and marginalized farmers. In the next chapter, we will explore future trends and innovations in Agri-SCF, examining how AI, big data, and climate tech will reshape the landscape in the coming decade. Chapter 12. Future Trends and Innovations in Agri-SCF. 12.1 Introduction. The next decade will see rapid transformation in agricultural supply chain finance, Agri-SCF, driven by technological innovation, climate imperatives, and new business models. Future trends point toward a more digitized, transparent, and inclusive system where finance is seamlessly embedded in transactions and sustainability is rewarded. 12.2 Key drivers of innovation. Climate change. Urgency to finance climate-smart agriculture. Digital transformation. Growth of mobile internet and IoT in rural areas. Data revolution. Satellite imagery, AI, and big data enabling precision finance. Investor interest. Rising demand for impact investing and ESG-linked returns. Consumer preferences. Shift toward traceable, sustainably sourced food. 12.3 Emerging technologies. 1. Artificial intelligence, AI, and machine learning. Use cases: credit scoring, yield prediction, price forecasting. Impact: improved risk assessment, faster loan approvals, and reduced default rates. 2. Internet of Things, IoT. Use cases: smart irrigation systems, soil moisture sensors, livestock tracking. Impact: better data for insurers and lenders, enabling pay-per-use models. 3. Blockchain and tokenization. Use cases: smart contracts, tokenized warehouse receipts, carbon credit trading. Impact: transparent, tamper-proof records and easier collateralization. 4. Big data and predictive analytics. Use cases: weather risk modeling, supply chain disruption prediction. Impact: proactive risk management and dynamic credit pricing. 5. Decentralized finance, DeFi. Use cases: peer-to-peer lending for farmers via blockchain platforms. Impact: reduced intermediation costs, increased access to global capital pools. 12.4 New financing models. Embedded finance 2.0, deep integration of credit, insurance, and payments into digital marketplaces. Revenue-based financing, repayment linked to actual sales rather than fixed installments. Climate finance instruments, green bonds and pay-for-performance funding for regenerative agriculture. Farmer data cooperatives, farmers monetizing their own data for credit access and better terms. 12.5 Role of climate tech. Climate-focused innovations are expected to attract significant investment. Carbon farming, financing farmers to adopt practices that sequester carbon. Drought-resistant crops, linking R&D financing to adoption incentives. Regenerative agriculture, rewarding soil health improvements through finance-linked KPIs. 12.6 Potential challenges. Digital exclusion, risk of leaving behind farmers without internet or smartphones. Cybersecurity threats, rising risk of data breaches and fraud. Regulatory uncertainty, emerging tech like DeFi still faces unclear legal frameworks. Data ownership concerns, ensuring fair use and consent in farmer data monetization. 12.7 Case studies. Case Study 1, Hara, Indonesia. Solution: blockchain-based platform that tokenizes farmer data for credit scoring. Impact: increased farmer access to finance and created a data marketplace. Case Study 2, Bank Global. Solution: blockchain-based identity platform giving farmers a digital economic identity. Impact: enabled traceability for global brands and financial inclusion for smallholders. Case Study 3, Agri-SCF, Europe. Solution: carbon credit platform that finances regenerative practices. Impact: monetized carbon sequestration and created new revenue streams for farmers. Case Study 4, Apollo Agriculture, Kenya. Solution: AI-driven platform providing bundled credit inputs and insurance. Impact: doubled farmer yields and improved repayment rates. 12.8 Key takeaways. The future of Agri-SCF will be data-driven, lending decisions powered by AI and big data. Inclusive, reaching even the smallest and most remote farmers through mobile-first models. Sustainable, financing tied to ESG outcomes and climate resilience. Transparent, blockchain ensuring trust across stakeholders. Globalized, access to capital from both traditional banks and decentralized networks. 12.9 Conclusion. The coming decade offers an unprecedented opportunity to build an agricultural finance system that is efficient, equitable, and climate resilient. Stakeholders must invest in digital infrastructure, collaborate across sectors, and create enabling policies to realize the full potential of these innovations. In the next and final chapter, We will summarize key insights, strategic recommendations, and the road ahead for Agri-SCF. Chapter 13. Conclusion and Strategic Recommendations. 13.1 Introduction. Agricultural Supply Chain Finance, Agri-SCF, is a critical enabler of agricultural growth, farmer prosperity, and food security. Over the course of this book, we have examined the evolution, models, stakeholders, risks, technologies, and future innovations in Agri-SCF. This concluding chapter synthesizes these insights and provides strategic recommendations for building resilient, inclusive, and sustainable agri-finance ecosystems. 13.2 Key Insights from Previous Chapters. Understanding Agri-SCF, Chapters 1 to 3. Agri-SCF addresses working capital gaps across the value chain. Models like pre-harvest financing, input credit, and post-harvest warehouse receipt finance are vital for liquidity. Risk Management, Chapter 5. Crop insurance, hedging, and credit guarantees are essential to make agriculture bankable. Technology like satellite imagery and AI enhances early warning and reduces default risk. Digital Transformation, Chapter 6. Mobile money, blockchain, and alternative credit scoring have opened new avenues for financial inclusion. Embedded Finance allows seamless credit dispersal and repayment. Role of FPOs and Institutions, Chapters 7 to 8. FPOs aggregate farmer supply, improve bargaining power, and attract financing. Banks, NBFCs, MFIs, and fintechs play complementary roles in deepening credit penetration. Policy and Global Lessons, Chapters 9 to 10. Stable policy environments, warehouse receipt regulation, and credit guarantee schemes are key enablers. Global best practices highlight the importance of cooperatives, futures markets, and blended finance. Sustainability and Future, Chapters 11 to 12. ESG, linked finance, and climate-smart agriculture are becoming central to supply chain resilience. Emerging technologies such as AI, blockchain, and IoT will shape the future of agri-finance. 13.3 Strategic Recommendations. For farmers and FPOs. Strengthen governance and record-keeping to improve creditworthiness. Invest in quality inputs and sustainable practices to access premium markets. Embrace digital tools for market linkages, financial literacy, and traceability. For financial institutions. Use alternative data sources for credit scoring to expand lending. Bundle loans with insurance and advisory services. Partner with agri-tech firms to lower cost to serve and monitor risk. For agribusinesses. Support suppliers with embedded finance and input credit programs. Promote traceability and ESG compliance to access global markets. Engage in long-term procurement contracts that de-risk farmer investments. For policymakers. Expand credit guarantee schemes and index-based insurance programs. Invest in digital public infrastructure, farmer registries, e-marketplaces. Create predictable policy environments to encourage private sector investment. For investors and development agencies. Channel capital into blended finance vehicles and climate-smart projects. Support capacity building for FPOs and rural entrepreneurs. Measure and report impact using standardized ESG metrics. 13.4 The Road Ahead. Agri-SCF is not merely a financial innovation, it is a development imperative. By closing the financing gap, it can lift millions of smallholders out of poverty, reduce post-harvest losses, and enhance food security, promote sustainable, climate-resilient farming, build stronger, more transparent supply chains that benefit all stakeholders. Collaboration between farmers, financiers, policymakers, and technology providers will be crucial. The future of agriculture finance will be digital, first, climate-conscious and inclusive, empowering farmers to not only survive but thrive. 13.5 Final Thoughts. Agriculture is at a crossroads. With rising global population, climate challenges, and shifting consumer demands, Financing agricultural transformation has never been more urgent. Agri-SCF provides the bridge between potential and prosperity, ensuring that every link in the chain is strengthened. The journey ahead calls for innovation, collaboration, and commitment to shared value creation. If stakeholders act collectively, agriculture can become a driver of economic growth, sustainability, and social equity worldwide.